Hello everybody. I am the ACCA tutor, Mr. James Timku. In this week's task, we are going to look into purchases and payables. Alright? As we move deeper into our ACCA FA1, FA2 hybrid class learning phase. Alright? Like I have indicated in the previous week, where we touched aspects to do with the cash book as well as the sales and sales ledger. In this week, we are also going to touch on some related aspects where we'll also be looking at things like the settlement discounts, alright, and a recap of the payables ledger system. Okay, but if you still remember, in our week 2, we introduced ourselves to the concept of books of original entry and books of double entry. Okay, where we say that for the books of original entry, we expect to find transactions in their initial recording stage. Alright, but when we talk of books of double entry, we are now referring to books which are part of what is called the double entry bookkeeping system. And these books, they take their details from the books of original entry. Okay, now for this part, for us to understand, I'm sure we need to have or to make some little drawing here. Let me just try to draw something here. Alright, we have got books of original entry, and some of them are original entry. These include the cash book, okay, the cash book for cash sales and or cash purchases. Alright, there is the purchases day book or a sales day book. Alright, there is also the journal, and the journal here comes into play when it is used to record non-regular transactions. For example, rent transactions involving rental payments, salaries, etc. Those ones are not frequent transactions. Alright, or some transactions which need some adjustments, some reversals, correction of errors, etc. They are not regular transactions. Alright, so the cash book, paid cash book, and so forth. But now we also indicated that the cash book is both a book of original entry, but at the same time a book of double entry. Why? Because it is related to the general ledger. It is a cash account of the business, so automatically it is part of the general ledger bookkeeping system, where we see all the double entries taking place. But we also hinted that there was a certain record which is called a memoranda record. Okay, memoranda record. This one has got two main books. We've got the purchases ledger or payables ledger, and sales ledger. Alright, these ones now, they are not part of the double entry. Although they bear the name ledger, they are not part of the double entry. They are only memoranda accounts. Memoranda accounts in the sense that they are only useful to track transactions related to individuals with which the business has got accounts. For example, they could be suppliers or they could be customers, where would be having some credit relationships. So we open these memorandum records for the purpose of having data available or readily available when it comes to accessing account information related to each supplier or customer. All right. Okay. Now you can see that while the memorandum records are not part of the ledger system or the double entry system, they are also entitled to get information from the books of original entry. So they are also updated by certain occurrences or events which are captured in the books of original entry. For example, if we buy goods from a supplier on credit, that transaction is recorded in the PDB, the purchases day book. Okay, the purchases day book. But automatically, we take information for each supplier and update our payables ledger. So each end for each supplier is then taken to update the payables ledger. However, from the same purchases table, we take the total of all purchases and update the general ledger in an account called the purchases control account or the payables control account. Okay, the payables control account. All right. So the way these records, the general ledger and the memorandum records, take information from books of original entry is different. The general ledger takes the total of all transactions in the books of original entry, while the memorandum records takes transactions per custom or per entry. This is done for control purposes. Alright, with this background, let us now go straight into the note and see how this links with the lecture of the day. Now, these are the objectives, as I've already indicated, to explore deeper into the purchases transactions and the payables ledger, including an understanding of documentation involved. Alright, because by the end of the day, there are certain documents which are related to the purchasing system. The purchasing system, ladies and gentlemen, is also called the procurement system. It has something to do with procurement, alright, or payment system. Payment system. We will also look at settlement discounts in purchases transactions, just as we did in the previous week's business. Now, a recap of the payables ledger system. In the payables ledger, each of the suppliers is credited with the gross amount of their invoice. So we all know that gross amount means the net amount and sales tax. So includes net amount and sales tax amount and the sales tax. So these figures would be including the net amount as well as sales tax amount. Please note that payables ledger is not part of the double entry system. It is a memorandum entry. So if everything is fine, the sum of the detailed accounts in the payables ledger will agree with the payables control account, which is found in the GL. we have indicated that already. This system fulfills the following functions. The control account provides an instant answer as to what is owed to suppliers in total. We are going to touch or to dedicate a particular lecture in the coming weeks on control accounts. Do not worry for now. Then, the detailed ledger accounts in the payables ledger give information about exactly what is owed to whom. Alright, so this is why I said that the payables ledger, being a memorandum account, is useful in giving us information related to particular particular suppliers. Alright, as it details information about each supplier's account, while the general ledger is the total collection of all the payables in an account called the payables control account, as you can see here. Now, this system also ensures the control account and the sum of the ledger balances agree and will reduce the chance of an error having occurred in the posting. Alright, so by having this particular system, it means that the risk of making errors is minimized. Now, entries in the payables ledger arise from two main sources. Right, I've also indicated that these arise from the purchases table as well as the cash book. The cash book comes into play when when we now pay the suppliers. Remember, these suppliers would be on credit. Okay, they would have supplied us goods on credit. So when we make payments, automatically that transaction is to be reflected in our cash book. So that's when the cash book comes into play. But remember, when we are talking of purchases table, these are credit purchases. Okay, we are talking of a record that keeps track of credit purchases, or that records credit purchases. Additionally, there will be occasional postings made from the journal, for example, offset of amounts to an account in the receivable ledger. This is why I said that the journal is also a record of original entry, in the sense that it records transactions which are not regular transactions. Okay, they are not regular, but it is also it is also used in the correction of certain errors for double entry bookkeeping. All right, where especially when we want to offset certain amounts to an account in the receivables ledger. All right, suppose, let's say we've got a supplier who happens to be a customer. Okay, they supplied us, but at the same time they buy something from us. So there is some need of setting off transactions or setting off balances, so that by the end of the day only the difference is to be paid. In that situation, we have to make those entries in the journal. Alright, the entries made from the purchase daybook would be credit payables control account with the total of the PDB gross amount. As you have seen here, this is the gross amount, ladies and gentlemen. Remember, the purchases daybook is indicated here. This is the purchases daybook. All this is an example of a page in the purchase daybook. It will be just a list of all the transactions which we have entered into with credit suppliers. Okay, it's just a list. All right, as you can see, this is just a list of transactions that have occurred in a particular day. but we need now to extract this information into some double entry bookkeeping system. So what happens is we have to follow our PL's acronym. The PL's acronym that says that the first three letters are debits. Okay, sorry. These ones are debits and these ones are credits. All right. So debits, the first three letters are increased by debiting. The P is for purchases, E for expenses, A for assets. So when we make a purchase, we have to debit purchases. Okay, we have to debit purchases, and the other ones here, these are revenue liabilities and things like share capital, etc. All right. Now, one thing I want you to say is, when we say that we debit purchases, it means that somebody, when we debit purchases, we have to credit somebody. Okay, we have to credit something, because the double entry system is about debiting and crediting. They should be equal. The credit side, the moment you debit something, something is going to be credited with the same amount. All right, that's the issue here. So when we debit purchases, when we make a purchase, we debit purchases, but somebody is to be credited. It's either if we make those purchases on cash, then we are going to credit cash because cash has left our business. But if we have made those purchases, or we have acquired those purchases on credit, then we have to credit the supplier or the payable. We have to credit the payable. So this is what happens here. This is this entry where we are saying that the entries from the purchases table will be credit payables control account. Why are we saying payables control account? Because this is the account which records all the suppliers in total. Alright, so we are going to credit that account. Okay, it is a payable. A payable in this our PLs is indicated by the L, or is represented by the L. This L is a liability. A payable is a liability. Why is it a liability? Because we are going to pay these suppliers in future. So they are payables. There is a potential of a payment. This is why it is called payable. 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 There is a potential of a payment in the coming future. Are we together, ladies and gentlemen? So this is what happened. So the double entry is, we are saying in the payables control account, payables control account, this is an account in the general ledger. Remember, these accounts are represented in T accounts. So what happens is we are going to credit this account. All right, we are going to credit this account. Okay, we can just say parentheses. All right, that's credited. All right, that's credited. All right, and then when we make payment, all right, when we make payments, we are going to debit. All right, when we make payments, we then have to reduce this either by cash, okay, or check or bank, something like that. All right, but as it is, this is the payables control account. Okay, now so we have done the first part. Okay, and like I have indicated already, right, the payables control account is credited with the total purchases. These are total purchases. Okay, total purchases, which we get from the purchases table. As you can see here, to update on this page, to update the general ledger here, we need to add all these amounts, and then the total is what we take to the GL. All right, the total is what we take to the GL, the gross amount. All right, so the total purchases. All right, total or gross purchases. Okay, and we then have to record in the purchases account. All right, we then have to debit the purchases account. All right, we have to debit the purchase account with the total of the PDB net amount. All right, the PDB net amount. So the purchases account. Purchases account. All right, we have now to debit. All right, to debit purchases net amount. Purchases net amount. Okay, with the same amount, and then the sales tax. The sales tax is also needs also to be recorded. All right, so this amount obviously should be tallied with the negative amount here. All right, that's the double end impact. All right, we can't record these in the same tier account, because you would see that it doesn't work like that. All right, it doesn't work like that. It doesn't mean that the transactions have to be recorded in the same T account. It doesn't work like that, because as you can see in the payables control account, here the payables control T account, you can see that whenever we buy purchases on sales, it means that we are increasing the credit side, but it is only being reduced is either when we make purchases returns, or make payments, cash payments to suppliers. Then those are then used to decrease the payables account. All right, so you just have to understand that the T accounts themselves are not going to be balanced. The debit side and the credit side are not going to be balanced by similar or direct transactions. Those direct transactions will be recorded in separate accounts, but the impact is going to actually be to come to the same conclusion, or would be the same. All right, so you need to understand that what would be going on. Remember, the purchases, these ones are a statement of profit or loss item. Okay, statement of profit or loss item, and this one is a balance sheet item or statement of financial position item. A payable is a liability. So the moment we buy goods, okay, for resale, all right, we are increasing an expense, but at the same time we are also increasing remember, these purchases are like an expense in the sense that we are incurring it for the purpose of trade. All right, so we are increasing an expense, but at the same time we are also increasing a liability. So we are increasing an expense, that's a debit. This is why purchases on the these are purchases, and these ones are expenses. They are actually in the same category in terms of the double end. Okay, their impact is to debit. They are increased by debiting. All right, so this is what is happening here. And then the payables are liabilities. They are increased by crediting. All right, so from the same purchases daybook, we are going to record entries in the purchases account where we are debiting that account. All right, we are debiting the purchases but at the same time we are also going to credit the payables control. Payables control, I said it is a liability. So in addition, each line in the gross column of the PDB will be used to credit individual accounts in the payables ledger so as to record exactly what is owed to whom. This is what I indicated, that by the end of the day, in the memorandum, we are not going to take in the memorandum account the payables ledger. In the payables ledger, we are not going to record the total of all the payables, but we are going to take each individual supplier's balances and update in his individual account in the payables ledger. All right, so we are going to take if we bought, for example, from OKMart and then from Metro Pitch and then from N Richards. All right, since these suppliers, we've got their own accounts in the payables ledger, we then have to extract each amount per each line to a relevant page in the payables ledger. Alright, but when we want to update the payables control account, which is the total of all those suppliers balances, we then have to add up. Okay, we add up and then we take the total and update the credit side of the payables control account. Now the entries made from the cash book would be, now from the cash book, remember, when we want to update the payables account, the payables control account from the cash book, it means that somebody has paid. We would have paid the suppliers the amount owing. So we would have to debit the payables control account. Why do we have to debit this account? Because we want to reduce the amount owing. We have paid something, so we want to reduce. So to reduce, we are not going to put a credit entry, because if we put a credit entry, we are increasing the payables. So we have to write to the other side of the payables control account, which is the debit side. We have to debit payables control account with the total of the payables ledger column. So in addition, each line in the payables column of the cash book would be used to debit individual accounts in the payables ledger so as to record exactly to whom payments have been made. If you are still confused on where these payables ledger column are found in the cash book, please refer to our previous week video. In the initial part of that video, there was some. So in video week 3 of the FA1 learning phase series, please get the grips of these matters in the previous week's video. All right, there I explained everything on the cash book aspects. All right, so please just refer to that part of the lecture in the previous week, like week number 3, I'm very sure. Okay, now let us talk about the documentation involved in purchases. When purchases are made, invoices will be received from suppliers. So we receive invoices whenever we make purchases. Then statements will be received regularly from suppliers, setting out what is still owed and what has been paid. Remember, these statements, supplier statements, they are just there as a kind of polite reminder that we are owing something, we need to service our account, we need to settle them. Alright, so it acts as a reminder. Then, when payments are made, remittance advices should be sent to suppliers to explain which invoices are being settled. Okay, this is good business practice. We need to send our money with some document, actually to help those suppliers to properly account for our monies which we have sent, so that they are also update their records accordingly. Now, the aspect of credit control, we talked about it the previous week, and it's still the same here in the purchases environment. We talked about it in the sales environment, where we have to actually first do some due diligence on our customers before we give them any credit. Similarly, in the supplier environment, the suppliers will also do the same whenever they want to give credit to their supplier. The process starts with a new customer applying for a credit, and this should initiate some investigation such as asking for the applicant's recent financial statements, inquiries to a credit reference agent as to see if their credit rating is actually of good merit. Based on these investigations, the applicant will be accepted or rejected. Yes, it's a two-way thing. Don't always expect to be accepted. If you don't meet their requirements, they are not going to accept you. A credit limit should be set for all customers, and it is important to ensure that when more goods are being ordered, that the credit limit will not be exceeded. Otherwise, delivery is likely to be delayed. Alright, so to encourage payments, like I've said, suppliers send statements. These are used to encourage payments as a gentle reminder. Also, they do offer settlement discounts like in the sales environment. Alright, suppliers also do the same. They sometimes offer settlement discount, okay, for early payments. Alright, now let us then do the mathematics part is involved. A business may have two types of cash discount, settlement or prompt discount. In each book we talked about this other. The first discount, the discount allowed. In our previous week we talked about it, but in this week we are also going to talk about it, on it, to ensure that our understanding is actually broadened. Now, discount allowed are cash discounts which have been allowed by a business to its customers when they pay their accounts quickly. Alright, then discount received. This is cash discount received by a business from its suppliers when it pays what it owes them quickly. We can now see the effect of discounts by looking at two examples. Alright, so ladies and gentlemen, let us fasten our seat belts as we now venture into this mathematical territory. Now, Elmo owed us $100. He pays us in cash on 2 September 2021, which is within the time limit applicable for a 5% cash discount. He pays 100 minus $5. Why? Because he is entitled to a 5% cash discount. 5% of $100, 5% multiplied by $100 is $5. So we are going to deduct the $5, and this guy is only going to pay $95 in full settlement of his account. Now, what is the effect of this transaction or this discount? Right, one, of cash. Cash is going to be increased by $95. Why is cash going to be increased? Because we are receiving cash from a customer. So the asset of accounts receivable is going to be decreased by $95. Remember, this guy had bought goods on 2 September, but he only paid some days after. Alright? Okay. He purchased goods sometime before the 2nd of September when he paid. So the transaction was initially recorded as a credit sale, all right, but there was a condition that if this guy pays within a certain time period, then he's going to be entitled to a 5% discount. So an entry in the receivables control account had been made about this guy, but we had opened the account as $100 receivable. Alright, because we can't actually trust that, we couldn't trust that this guy would pay up. Customers are not forced to pay up early. Alright, but we encourage them by this discount. Alright, so when he pays, then cash increased by $95. is increased by $95, and assets account receivable is decreased by 95. All right, so in double entry sense, we record this as debit cash amount, enter $95 in debit column of the cash book. Remember, the cash book is a T account like this. This is the debit, this is the credit. Okay, and we say that we are saying you say cash $95. Okay, cash received from Elmoyo. Received from Elmoyo. Alright, because if you don't indicate that this cash was received from Elmoyo, it could be accounted for as any other cash sale in the cash book. So you have to indicate that this was from a credit customer. Then we are going to credit Elmoyo. Alright, we are going to credit Elmoyo. Alright, but one thing for certain, you are not going to write this credit entry in the cash book. Alright, this is why I say that the accounts doesn't mean that the double entry, the debit side transactions are actually or directly linked to those in the credit one. No, they are different. They are different. Don't make that mistake. This transaction, the credit side, is only going to be shown in the receivables. Okay, the receivables account, receivable control account. All right, the receivable control account, where we are going to record the credit. Okay, a credit account. You're gonna say cash. Okay, cash 95. Why are we recording on the credit side of the receivable control account? Because the receivables are assets. Assets. Initially we had recorded the Elmoyo, all right, is $100 initially, all right, but he paid now his account. All right, this was the debit side, because whenever a receivable makes a transaction or they collected goods from us, we are debiting the receivable control account. Are we together, ladies and gentlemen? We are also debiting this individual client in the receivables ledger, the memoranda account. There was Elmoyo's account. All right, this guy was receiving, so he was receiving goods. So he was receiving. So these were sales. All right, Elmoyo or credit sales, and $100. He received goods. He was receiving goods, so $100 debit in his account. Also, similarly, there was a debit entry in the receivables control account. This one is a general ledger account. You can see that this is why these guys are called memoranda accounts, because we can't have a situation of two debits occurring at the same time. That would be double accounting. So these ones are not part of the double entry. They are just memoranda account. So for us to easily keep track of what is going on with our suppliers and our customers. All right. So there was an open entry in the receivable control account where Elmoyo was a receivable of $100. Now, when he made cash here, we credit the receivables control account to reduce that account. All right. The idea is to reduce the account. Now, what is the impact of the discount? You can see that there is an impact. The asset of accounts receivable is decreased by $5. All right, the asset because our original receivable was $100. All right, was $100. But when we offer a discount, then the asset of accounts receivable is decreased to $95. So it is being decreased by $5. All right, it is being decreased by $5. Okay, so you can see that this one now we then have to say discount allowed here $5. All right, discount allowed $5 because we have decreased that account by $5, and that discount allowed of $5 is going to be transferred to the statement of profit or loss as an expense. It is an expense. All right, you also have to record it in the debit column of the cash book. All right, in the cash book you then have to record it as an indication that it was an expense to the business. So after the cash was paid, there remained a balance of $5. The account has been paid. This asset must be counted. Expense of discount allowed increased by $5. Now, for the recording of the discounts allowed or discounts received in the cash book, please also refer to our previous week's video on that aspect. Okay, on that aspect. Now, the business owed D. Mushibe $400. In this case now, it is the business, it is us now owing the supplier $400, and the supplier happens to be D. Mushibe. It pays him by check on 3 September 2021. So some days on 3 September, which is some days later, he then paid up. We then pay up the payable, which is within the time limit laid down by him for a 2.5% cash discount. The business will pay 400 minus 10, which is 390 in full settlement of the cash discount. All right. So what then happens? The effect of this transaction is that the asset of bank is reduced by 390 because we are paying somebody, we are paying out money. So the liability of accounts payable is also reduced by 390. All right, so we are going to credit bank in the credit bank column for 390. All right, remember the cash book, ladies and gentlemen. Let me just try to have it. Okay, there is also what is called a 3-column cash book, ladies and gentlemen. And again, this is our debit, this one is our credit. All right, we have the details. Okay, dates, details. Okay, some discount received. This one on this side is discount allowed, the debit side, and then we have got something like the cash and bank. All right, cash, bank. You can have another entry for references or folio. All right, and then on the credit side, after this separator here, separator line, we have got the dates as well as details of the transaction, the reference, the discount received, okay, discount received, and then cash and the bank column. All right, so here we credit bank, and in the credit bank column for 390. So what happens is we are going to record on the credit side, okay, the credit side we say bank, okay, bank, or we can narrate further and say payment to DMShipe, and we put some reference here, and then we then say 390. This is the credit, the bank end, okay, the bank column, credit bank column. There is, this one is the debit bank column, okay, this one debit cash column, because they are on the debit side of the cash book. Are we together, ladies and gentlemen? Okay, so that's 390 there. It doesn't mean that we have to directly, because this is a cash book, and then we understood that the cash book is part of the double end. It doesn't mean that we have to automatically write a 390, the other 390 on the double, on the debit side. No, it doesn't work like that, ladies and gentlemen. Please always remember that. It doesn't mean that these transactions should cancel one another, because by the end of the day the debit side and the credit side should be balanced. No, it doesn't work like that. All right, it doesn't work like that. All right, so what it means is one debit entry is going to be on in a particular account, or crossing another account's credit balance. That's the essence of double entry. Okay, the impact does not need to occur in the same account, but it will affect another account. Okay, now so we are going to credit this. Then which one are we going to debit? We are going to debit, ladies and gentlemen, DMShipe's account, or by 390. So DMShipe is the supplier, so his account is going to be affected. All right, DMShipe's account is going to be affected because he's a supplier. So a supplier by nature, okay, suppliers, DMShipe is a supplier. All right, we had initially recorded a credit entry in the supply, but when we now want to make, all right, this one was the payable. So here's purchases, okay, purchases. All right, so when we make a payment, we're going to say cash. In this case, it's bank. Say 390. Initially, we had made payables of purchases of 400. All right, that was the record initially. That was the record. Okay, but we made payment 390 now. So it means that the balance should be discount received of $10. Then our account balance is 400. This is in the individual account, in the payables ledger. This is the payables ledger entry, because that's where we see Dim Shipesi account in the payables ledger. Alright, so in the payables control account, this is now a general ledger account. Initially we had a total, in total there were 400. Okay, there were 400 total payables. We don't consider Dim Shipesi alone, we consider payables in total. So we assume they were all 400. Okay, so when a payment is made, we do the same thing. We record the bank here, the bank 390, discount received $10, and we are going to have 400. Now when it comes to Dim Shipesi's discount, we're going to debit. Okay, we're going to debit Dim Shipesi's account, alright, with $10, as we did here. Alright, we have debited his account with $10 and credit discount received account with $10. Alright, the discount received account itself, it represents income or revenue. Alright, so on the POs acronym, if you still remember there, I indicated that on the POs here, on the POs, the R is revenue, is income. So it's increased by credit. It is increased by credit. Alright, so this is why we are going to credit the discount received of $10. Now discount columns in the cash book, ladies and gentlemen, this is what I have been trying for the discounts for the customer side. This is the customer. Elmo was the customer, and this is why we put the discount allowed $5 on the debit here. Okay, because to us it is reducing. We were supposed to have received a full $100, but we only received 95 on the debit side. This is the debit side, ladies and gentlemen, and this is the credit side. So you can see that a receipt of $95 is being recorded in the cash column on the debit side of the cash book, and the discount allowed of $5. Why is it a debit? We didn't receive anything, but it is an expense to the business. It is an expense to the business. So in the POs acronym here, we also indicated that the expenses here, the expenses are also increased by debit. Expenses are a cost. They are in the same bracket as purchases. They are increased by debit. They are also in the same bracket as assets. They are increased by debiting. Alright, so discounts allowed are debits because they are costs to the business, the expenses to the business. So in the cash book, you will see them as on the debit side. Why did we put them here? Because by the end of the day, we have to know that Elmo has settled his account. Alright, so if auditors want to know, because in the bank statement they're only going to see a figure of 95 instead of $100, so we need that record, and the record should be found in the cash book here. So the 5 is going to be written here to make sure that there is an audit side. There is an audit trail. The customer did not pay the full $100. He was entitled to a discount, so he was allowed to get a discount of $5. Similarly, on the credit side, we have got Mr. Dim Shipesi here. Mr. Dim Shipesi was willing to let go the $10 to us, so it was our advantage. So it was an income, but we also made a payment of $390. Our account initially was $400, So for auditors or for managers to see what happened with the $10, why didn't we pay it, we have to see that in the cash book it was considered a discount received. Now let us go through this fully worked example together to see what or how we have to record these transactions. So ladies and gentlemen, go through this example. On May 1, 2021, balance is brought forward, brought down from April. Alright, so some opening balances. The cash balance was 29 and bank balance was 654. Accounts receivable, BCom 120 and Campbell to the 80, Dishan to 40, accounts payable 60, Allen 440, Aralong 100. These were accounts payable and these ones were accounts receivable. Now, on the 2nd of May, BCom pays us by check. Remember, BCom is our customer here, so he pays us by check, having deducted 2.5% cash discount of $3. So we paid 170 instead of 120. Alright, and we pay along his account by checking, deducting 5% cash discount 95. Remember, with along our account was $100, so we paid only 95, and then we withdrew $100 cash from the bank for business use. These were drawings, and Campbell pays us his account by check, deducting 2.5% discount, the 273 from how much? And Campbell's here, we were supposed to pay 280 according to the record, but we ended up paying 273. We then paid office expenses in cash 92. Then D Shanti pays us in cash after deducting 5% cash discount, so that I. So D Shanti was supposed to have paid $40. Was supposed to have paid 40, but he only paid 38 because he was entitled to a 5% discount. 5% of 40, that's $2. So this is why he paid $38. We pay you borrow by check less 5% discount, $3. So and borrow, we had a $60 balance there, but we were allowed to deduct 3% and 5% discount, that is $3, and we ended up paying 57. We then pay A Allen by check less 2.5% cash discount, that is $11. Now, let us then try to come up with the cash book. Alright, let us try to come up with the cash book. The first thing we have to do is to breathe and relax. We mustn't panic because we are going to face this in the exam. So we need to be strong. Accountants are strong, hard-hearted individuals who have to be strong. Alright, so let us do it. Now, the cash book. Let me try to draw some lines here. I'm not a good artist, but I'll try to ensure that you understand what is going on. Okay, this is the separator, but we need to, because the transactions are involving both the bank and the cash. As you can see here, we've got this balance, this is the cash balance and the bank balance. So we have to come up with a cash book that should be considered a 3-column cash book. Right, this one, the separator is usually represented by 2 double lines. I mean by double lines. Okay. Alright. So this should be discount allowed, which is always on the debit, then cash, bank. Okay, we can be a bit innovative and have a reference column. So right, this is the debit and credit. Okay, let me try to come up with this beautiful column. The ref. Ladies and gentlemen, consider these ones beautiful because I'm waste of this. Okay, the discount. Alright, cash back. Now, we didn't have to be led by the question because question should take lead or the time. Okay, this was May 2021. Right, everything was occurring in May 2021. Now, we are told that we had opening balances, cash balance of 29. So, the first we've got balance BD, cash was 29. Okay, everything is in dollars. Remember, everything is in dollars. Okay, and one thing you have to realize is all these balances were positive figures, so it means that they were balances not in overdraft. They were opening balances not in overdraft. Alright, and then there was also a bank balance of 654. Alright, we then have to consider what took place from the second. Alright, on the second, BCom pays us by check, having deducted 2.5%, that is $3, and we paid $170. So BCom was our receivable, right? So you can just say BCom, second BCom, okay, BCom. For the entry, we can just say add 3. Alright, it depends on the company, their referencing system, and so forth. Remember, this should be linked to the sales ledger because a customer is first recorded in the sales ledger. So you can have a coding system where we start with an SL for us to remember that this is a sales ledger code. Okay, so something like that. So SL3, there was a discount allowed of $3. Okay, $3 discount allowed, as you can see here, and 117 was recorded. Alright, 117 was recorded, and it was paid by bank. Okay, remember it's a check. Alright, what then happens? We pay our loan. We pay our loan by check. By check means the bank entry. The entry should be in the bank column. Deducting 5% cash discount. That's $5 cash discount. So our loan was paid our loan. So on the 8th, our loan. Okay, and this should be in the purchases. Payables. A payables ledger. Alright, a payables ledger is also another memorandum account entry, and this one was a payables sales ledger, which was also a memorandum account. Alright, and we have to update the sales ledger and payables ledgers this accordingly. So the payables ledger reference, you can call it number 18. All right, it's just hypothetical, and we received a discount after a discount of $5 after paying $95 within the time. So $5 was received, and we use a check, so it's a bank transaction. All right, we go back to the question, and we withdrew $100 cash from the bank on the 11th. So we withdrew drawings of the 11th, cash withdrawn, and there could be some other entry where we can say X4. All right, some other references depending on the company, and it was cash of $100. Okay, remember we are withdrawing from the bank. We are withdrawing cash from the bank, so the cash can't be recorded here. Okay. Then N Campbell pays us his account by check, deducting 2.5 discount, $7. So N Campbell is somebody who is the customer to us. So we come. But there is one thing I want you to see here. When we withdraw cash from the bank, all right, we then have to receive the actual cash in the cash account. All right, so we have this case now. We have that which is paid in the cash account. All right, and we can have the same reference, but these are like contra entries. They're just the same anyway. But anyway, we can just give them the same reference. Right? They are like contra. They are handling one another, but we need to record them. All right? Because they have to be reflected in the cash flow. All right. So we are receiving money in the cash account from the bank. Okay, so let us now record the N Campbell, the Campbell transaction. Campbell, for this guy paid up his account, and you can say SL 06. All right, paid his account, and we allowed him a $7 discount, and he paid $273. All right, so the check. We paid office expenses in cash. This time it's cash, so that's 92 a payment. What was the date? The date was on the 25th. Office expense. Office expense. Right. Normally, these ones, they are non-routine transaction. We might be having a general ledger entry, a GO entry, or we can have a journal entry, a journal reference, okay, from the journal. Okay, all right. So we have the journal ledger entry, a GL 27, right? GL 27 entry, and we paid by cash. That's $92. We Go back to the question. D Shanti pays us cash after having deducted 5% discount. What was the 5% discount? D Shanti is here. This amount was 40 multiplied by 5%. That's $2. Okay, so we have to record that $2 first as a discount allowed. So D Shanti, the date was 28. D Shanti. D Shanti. D Shanti. Or it's Shanti. D Shanti. D Shanti. This is a sales ledger entry. Okay. D Shanti. Alright, so the $2 should be accounted for, and then he paid us by cash. So that's 88. Alright, go back to the question. This one is done. We pay you borrow by check, less 5% cash discount of $30. So you borrow on the 29th. Borrow. Legacy ledger 07. You paid by cash, and the discount was how much? $3.50. Okay. Alright. This one. Perfect check. Was the checking? So the balance of checking. Alright. You just have to do that in the exam. Just have to cross check your work, because at the end of the day you might be penalized for silly things. You can't afford that. You just have to recheck your work. Then we pay A Allen on the 30th by check again. So it's a bank transaction after deducting $11. So A Allen on the 30th. To $11 or $4.29. Okay, then after we do this, we then have to balance up the cash book. So the 3 columns have to be added. So if we add up this first column, that's 12, and the second one should be 17, 7 and 11, 14, that's 0, 4. Okay, so we then have to add this to cross check if these balances are in agreement. Alright, but even if we want to see which should be our balance carried forward, the discount column, they're not going to be subject to the balance discount received carried forward or discount allowed carried forward. No, it doesn't apply to them. So do not be confused with them. Do not be confused. Alright, so just have to add them, and you know the amount, and you leave it like that. Okay, because they are actually not related these entries, I mean these columns, they do not have anything in common. They are not subject to any balance carried forward and so on. Are we together? So 8. Then we then have to check the balances as they are from the debit side, because it seems the debit side has got the larger balances. All right, and then we put our balances CD, balance CD. It's okay. So the balance CD, we then have to, like I said, it doesn't affect these discounts received. They are not subject to any balance CD, so you just have to check, ignore that column, and you go to the cash and bank column. So here, that's 92 minus 167. We're going to have some 75. And then here, if you do your mathematics very well, you just have to come to a balance CD of receipts. Alright, then you have to check that to the June 1st. Okay, the next month is the balance DD. Balance DD. Arrows are confusing. Alright, so just have to take from the cash and bank column on. That's where we have got our balances CD. Please be careful here. This is where students get confused along the way. Alright, so we have done the cash book, ladies and gentlemen. This is how the cash book should appear. Alright, this is how the cash book should appear. I'm sure we are done there, and on the way we should have recorded the sales ledger. I'm sure we covered that in our week 2 lecture. Alright, or the payables ledger, we also covered that. For example, let me just try to pick one customer here, one receivable and one payable, to show you how the sales ledger should have been completed. Alright, but I do not have much space. That's a problem. Okay, let me try to squeeze it here. Alright, let me just try to elaborate the sales ledger. The sales ledger. Okay, sales ledger, and let's talk of BCom. Okay, BCom's account. BCom, the T account. Now, a T account now. Remember, BCom took goods on credit. Okay, we took goods on credit. From the question, BCom took goods worth 120. So his balance as at May 1 May, the balance was 120. Alright, but there were some payments which were made. If you go back to our cash book, let me try to check the pen color. Okay, BCom paid $3.01. He was allowed a discount of $3 and he made the payment of $1.17. So to record this, we just say bank, okay, on the 2nd of May. On the 2nd May, paid by check. So then 170, and then he was entitled on the same date to a discount allowed of $3. Alright, so if you balance up, you get 120 120. This is in the sales ledger, ladies and gentlemen. Okay, that's in the sales ledger. All right, now for a payable, let us try to see how this was being recorded for other loan. Let us try other loan who gave us a $5 discount and we paid only 95. We just do the same thing. This is a payable other loan. Payables ledger. Okay, payables ledger, and payables by nature, their balance on 1 May was on the credit side. The balance was from the question. The balance was this loan, other loan was 440. Okay, so that's for Mr. Loan. That was that one is for Alan. 440 is for Alan. 440 is for this one is for Alan. For Mr. Long is 100. Sorry then. For Mr. Long is 100. This is why we are having 5 and the 95. So on 1 May, this guy made 100, but we then paid 95, and it was it bank? Yes, it was by bank here. So that's bank 95, and then discount receipt $5. You add that, get 100. Okay, I think this is how, ladies and gentlemen, you have to come up with the sales ledger or the payables ledger. All right, and we have also discussed about how you have to complete this transaction in the general ledger, because when you are recording it in the general ledger, only the total balances are considered. For example, for the payables ledger, it becomes the payable. For purchases, it becomes payables control account. For sales ledger transactions, or for sales transactions, they are accumulated in what is called a receivables control account. All these balances are taken from the totals of their respective books of original entry. For purchases, we take the totals of all the purchases to the payables control account. For sales, we take all the total credit sales from the sales table to the general ledger receivables control account. I'm sure that I have been clear. Now, let us sum up things here. How are payments made to suppliers? This is the business of this particular part of the ledger. Alright, let me just try to erase to avoid the clutter. Invoices should be paid when due. Alright, what happens if they are not paid on due? We lose settlement discounts as we have just discussed. Suppliers might become reluctant to continue giving us credit or even to continue doing business with us. Payment due list can be prepared from the payables ledger. Okay, the payables ledger, because the purpose of memorandum accounts is for us to quickly get all the information we need for each particular supplier. This is rather like the aged receivables analysis. A senior official will then go through this list and mark which payment to make. Alright, Payments can be made by internet transfer or by check, but before payments are made, they have to be carefully authorized to prevent incorrect amount being paid or defrauded from the company. Often the person approving the payment will want to see the supplier's invoice, the goods received note, and the code of the authorized order. Together, these three documents provide a good standard of proof that the supplier should be paid. All payments should be accompanied by a remittance address that sets out what is being paid so that the supplier can keep track of the discount. Ladies and gentlemen, I hope you have benefited a lot from this video. If you feel you need more coaching, I'll always be there for you. Please just get in touch with me on the available numbers or visit my website at www.transferconsulting.co.zw. That's where you can get more information about us and me as well. Like I have always indicated, it is better to strive to invest more in yourself for a better tomorrow for both you and the entire universe. Until next time, ladies and gentlemen, may the good Lord continue to bless you abundantly forever and ever. Amen. I'm signing out. Goodbye.